The Ultimate Investment Strategy Guide. Investing is a powerful tool that allows you to put your money to work. This helps you reach your future financial goals. If you're new to it, the world of investing might seem big and confusing, but you can make it simpler by following some proven strategies. These popular investment choices can help you with different financial goals and set you up for a secure financial future. In this video, we will share 5 ultimate guides to help you get started. Number 1, invest in yourself. The first hack to an effective investment strategy that gives the desired return is for you to invest in yourself. Start making smart choices to improve your skills, knowledge, and overall well-being. It's not just about putting money in stocks or bonds, but about spending time and resources to become a better version of yourself. This can include getting a good education or learning new skills. When you invest in yourself, you're essentially making an effort to increase your value, just like you would invest in a business to make it more successful. Investing in yourself is like giving yourself the best foundation for financial success. It's a crucial principle, especially if you're new to the world of investments. Instead of diving straight into complex financial instruments, take the time to invest in your knowledge and understanding. When educating yourself about investments, this doesn't mean you need a fancy degree. It's about learning the basics of how investing works. There are numerous resources available, from books, videos, and online courses to workshops that can provide valuable insights, including this channel, so be sure to hit the like and subscribe button. Understanding what you want to achieve through investing is key. Define your financial goals, whether it's saving for a home, planning for retirement, or funding your dream vacation. Knowing your goals will guide your investment decisions and help you stay focused on what matters most to you. Think of yourself as the most valuable asset in your investment portfolio. Just as you'd research before investing in a stock, take the time to understand your strengths, weaknesses, and areas where you can grow. This self-awareness can guide your personal and professional development, ultimately increasing your earning potential. The more you invest in your skills and knowledge, the more you enhance your ability to make your money grow. Number 2, paying off high-interest debts before you start investing. Equally important before diving into investments, it's wise to prioritize paying off high-interest debts. Imagine debts with high interest rates as obstacles on your path to financial success. High-interest debts, like credit cards or certain loans, can accumulate rapidly. The interest you pay on these debts might exceed the returns you could potentially gain from investments. So if you settle these debts first, you're preventing your hard-earned money from being eaten away by interest. Clearing high-interest debts contributes to financial freedom. It's like lifting a weight off your shoulders. Once you're free from these burdens, you have more disposable income that can be directed toward investments or other financial goals. We all know debt can be stressful. Addressing it head-on provides peace of mind and reduces financial stress. This mental clarity is invaluable when making investment decisions, allowing you to focus on long-term strategies without the constant worry of outstanding debts. Timely debt repayment can positively impact your credit score. A good credit score opens doors to better interest rates on future loans, creating a healthier financial environment for your investments. Think of clearing high-interest debts as laying a solid foundation for your financial house. It ensures stability, making your financial structure stronger when you eventually start investing. Number 3, take advantage of tax-advantaged accounts. Use tax-advantaged accounts, such as Roth Traditional 401k and Roth IRA, to reap the special benefits they offer, which can boost your wealth over time. With a Roth Traditional 401k or Roth IRA, you get to choose between tax-free growth or tax-deferred savings. In a traditional 401k, your contributions are often tax-deductible, meaning you don't pay taxes on them immediately. The money grows tax-deferred until you withdraw it in retirement, at which point you'll pay taxes. On the other hand, Roth IRA contributions are made with after-tax dollars, but the growth and withdrawals are generally tax-free. Because these accounts provide tax advantages, more of your money can stay invested and work for you. Contributions to 401k accounts are often automatically deducted from your paycheck, making it a convenient way to consistently save. Many employers offer 401k plans with matching contributions. This is essentially free money. If your employer matches your contributions, you are getting a bonus for saving for your future. We should also point out that many employers offer a Roth 401k. This is huge for earning tax-free money. You and your employer contribute into your retirement each month, and when you retire, you can use this money completely tax-free. If you're saving money for something other than retirement, it's a good idea to avoid retirement accounts. These accounts, like IRAs, are meant for retirement savings and come with rules about when and how you can access your money. A better option might be a taxable brokerage account. The cool thing about these accounts is that you can take money out whenever you need it without worrying about extra taxes or penalties. Number 4, diversification. Instead of putting all your eggs in one basket, you spread them across different types of investments. One way you can manage risk in your portfolio is through diversification. Create a mix of different investments in your portfolio to avoid putting all your money into one type. Talk to a financial advisor after a quick conversation about your risk tolerance, age, and annual contributions. They will advise a plan with different diversifications for you to pick from. Think of it this way. If all your investments are in one company's stock and that stock performs poorly, your whole investment plan takes a hit. Picture a portfolio with lots of stocks from different sized companies, various industries, and around the world. It's not just stocks. There are also other investments like bonds. If one stock doesn't do well, it won't hurt your whole portfolio much. This spreading out of risk is the beauty of diversification. You can easily do this with affordable index funds or ETFs. Choosing an index fund is an easy way to invest, especially when combined with a buy and hold strategy. Your profits will be an average of all the assets in the index. Having a mix of investments lowers your risk compared to owning only a few stocks. The best part? You don't need to analyze individual stocks, making it less work for you. This leaves you with more time for enjoyable activities while your money keeps growing. An ETF is like a mutual fund. They both bundle various investments together. The difference is that ETFs trade like stocks during the day, and you buy them at a share price. ETFs often have a lower share price compared to the minimum investment needed for a mutual fund, making them a solid choice for new investors or those with smaller budgets. Oh, and index funds can also be ETFs. Nice, right? Another thing here is rebalancing. Over time, your investment mix can change. For example, if stocks are doing well, they might become a larger part of your portfolio than you initially planned. Rebalancing is like fine-tuning your investments to ensure they align with your goals, time frame, and risk tolerance. So, if you find that your portfolio has shifted too much towards stocks, you might decide to sell some stocks or put new money into other assets, like bonds. This way, you keep things in balance according to your original investment strategy. Number 5, be consistent with your investment contribution. Keep things steady by regularly putting money into your investments. Being consistent with how much you contribute helps your money grow steadily over time. Stick to a routine. The more you invest consistently, the better your long-term results can be. Over time, you will experience the power of compounding. It's like a snowball effect. Your money grows faster and faster. The longer you leave it, the more powerful this compounding becomes. So think of it as a super boost for your savings and investments. Dollar cost averaging is a smart way to invest regularly without stressing about price changes. Here's how it works. Let's say you want to invest $1,000 every 3 months in an ETF following the S&P 500. The ETF's price goes up and down each quarter. But because you're investing the same amount each time, you end up buying more shares when prices are low and fewer when prices are high. This helps you get a lower average share price over time and keeps emotions out of your investment decisions. Knowing this, ups and downs in the market are normal. When you resist the urge to sell during market dips, you give your investments a chance to recover and potentially grow over time. Buy and hold is like riding out the storm. It might be bumpy, but history shows that markets tend to bounce back. Additionally, holding onto your investments for the long term often means you pay fewer fees. Frequent buying and selling can eat into your returns with transaction costs. By staying committed to your investments, you not only avoid these fees, but also benefit from the compounding effect, where your returns generate even more returns over the years. The buy and hold approach is a strategic move to stay calm during market tough times, save on unnecessary costs, and let the power of time and compounding work in your favor. What are your thoughts? Let us know in the comments below, and if you found this guide helpful, be sure to like and subscribe for more valuable content, and hit the notification bell to stay updated on our latest investment guides.